In this presentation, we're going to practice creating another invoice within QuickBooks Online. We'll do this a little bit faster since we did one last time. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. We're going to be creating another invoice. So just to recall, we're going to go back to our flowchart on the QuickBooks desktop because I just want to look at the flowchart here. We're in the invoice, so we're going to be creating another invoice here. That means accounts receivable is going to go up. We're basically selling a guitar, so we're going to imagine we're selling a guitar. We're shipping out the guitar with the invoice. We expect to receive the payment later in the mail. If we were going to sell them at the same time, remember that we would be using then a create sales receipt, meaning if we made the sale and got the cash at the same time, we would be doing this. Here, we're going to be creating the invoice. Just depends on the type of business we have as to which one we would be using more often. So I'm going to close this back out. Let's open up our reports first this time, just to do things a little bit differently. We're going to go to the reports down below. We're going to be opening up our favorite reports. That's going to be the balance sheet report. So we're going to open up the balance sheet report. Going to change the dates up top, and we're going to make those dates be 01/01/20 to 12/31/20, and then we're going to run that report. Then I'm going to duplicate that report up top. I'm going to say right-click and duplicate. So now that, and then I'm going to go back to the other tab, to the tab on the left, and then we're going to go down to the reports again. We're going to do this again, this time our second favorite report being the P&L report, the other kind of financial statement report, the core report, the basically income statement type report. We're then going to run the dates up top again. So the dates up top are going to be 01/01/20, 12/31/20, January through December 2020. We'll run that report. Then we'll go back up and we will duplicate it, right-click it on the tab up top and duplicating that report. Then we're going to do this one more time for the other report that I like to see oftentimes when I'm working on these things. Notice this is the first thing we do every time we start working this in practice, same. So we're going to go down to the reports down below, and then we're going to be opening up the trial balance. So the trial balance, the trusty trial balance, which is way at the bottom but should totally be at the top because it's a really useful report. Changing the dates up top, 01/01/20 to 12/31/20, and then we're going to run that report. Then I'm going to duplicate the tab again, right-click it on the tab one more time, and duplicating it. There we have it. Then we might want to go through these reports now, and when you start to make the document or the form, you may want to think first, what's going to be the effect on these reports? What's going to be the effect on the balance sheet? If you go to the balance sheet, make it a little bit larger, I'm going to hold down Control, Shift up to 125. I'm going to close the hamburger. And then you can think, what's going to happen on the balance sheet? Well, we know that the accounts receivable is going to go up. That's one thing that's going to go up. We're going to sell something that has sales tax. So we would expect the sales tax, or the people we owe, the liability, to go up because we owe the government for the portion that we have to collect that is theirs. So those are going to go up, and we know we're going to sell inventory. So you would think inventory would be going down. Then if we look at the P&L, well, what's the effect on the P&L? Well, if you look at the P&L, you'd say, well, we're going to sell something, so I think revenue would go up. We're going to sell a piece of inventory. Therefore, we're also going to have the cost related to the selling of that inventory. That means the cost of goods sold will be going up. The net of the two will be the effect on the net income. If you look at the trial balance, then you could see all that happening on one form. And you would think about it this way. In journal entry format, accounts receivable is going to go up. And then the other side of that is going to be sales, which is going to be down here on the income statement, is going to go up. But there's going to be a difference between those two, which is going to be the sales tax that's going to be owed, which is going to be a liability. So that's going to be somewhere here in the liability. Here's the liability is going to go up. And then we're going to have the inventory, the other journal entry, inventory, the other side of things, going down. And then we're going to have cost of goods sold down here going up. And so if you can imagine kind of the cutoffs on where the assets stop here, liabilities start here, then the equity section, then revenue and expenses, income statement, then you can see this all in one sheet a lot faster. All right, let's do it then. We're going to go back to the first tab. We're going to go to our plus button. We're going to the money in, even though money isn't in yet because it's basically accounts receivable is going to go up at this time. We're going to make a sale. I'm sorry, we're not doing that. We're going to make an invoice. I'm going to close out the make a sale. We're going to say new, and we want an invoice. We're going to send an invoice. And within the invoice, it's going to be going to our customer called Anderson Guitars. So we're going to be putting in Anderson Guitars, which you can do by the drop down or simply start typing in Anderson. And then if we had an email, we would be populating the email for them. and we can send it by the email, online payment options. Then we have the billing address and the terms. Net 30, we're going to put this once again as of January 12th. That means the due date, if it's net 30, will be 30 days later, populating for us at the 2/11. Invoice is then generated for us. We're then going to go down to the product and service, and we're going to sell them a Steinberger solid body. So a Steinberger solid body. Here, this is the one, the SSB. We're going to sell them an SSB, Steinberger solid body. Then it will populate for us. This is a type of guitar, by the way. And then it's going to have the rate here, and it is taxable, should be populating. That should be populating for us, the taxable item there. And then I'm going to make this a little bit smaller. I'm holding down Control so I can see everything and put it down to 100%, back to 100%. And there we have it. Okay, so if we analyze this invoice again, you just want to think about what's happening, see how easy it is to populate the invoice. Once everything is set up, then you want to consider what's going to be happening. Now, note, again, the sales tax, you may have something different if you have a different state that you put in here. Once you have some state in there, you could change the sales tax by clicking here, and then you can match out what we have in our problem if you so choose, if you want to basically tie everything out like perfectly. Okay, so that means what's going to happen here? Well, we have an invoice. Invoice means... And now, notice I'm imagining what's happening on both ways. I imagined we had thought about what's going to happen from the financial statements before we made the invoice. Now we're going to imagine what the invoice is going to do to the financial statements. Then we'll take a look and see if that is indeed the case. So we got the accounts receivable that is going to go up because it's an invoice. It's going to go up by the full amount of the 448. The other side, 95, 44895. The other side is going to be sales, but it's only going to go up by the amount we get to keep, the 410. The difference being the sales tax that we don't get to keep. We have to collect that. The state is making us get that money, not for us, but for them. So that's going to increase the liability that we owe to the state, $38.95. Then the second half of the transaction is going to be the cost of goods sold and the inventory. In other words, inventory is going to be decreasing. So inventory goes down, not by any amount on the actual invoice, because we don't want to tell the customer how much we paid for the guitar. We only want to tell them how much they have to pay for the guitar. But the invoice does drive it by the knowledge of the item that we put into the system. And then the other side is going to be going to cost of goods sold. All right, so let's go ahead and record this and see if we can then check that out if that is indeed the case. We've got it all visualized in our head, like what's going to happen. And then we're going to save and close it and see if that is indeed what does happen. So I'm going to say save and close. Then let's start off on our trusty trial balance. We're going to go down to our over to the right to our trusty trial balance. We could refresh the screen. I think it refreshed for us though. Let's check it out. If I go into the accounts receivable, it should go up. So if we go into the accounts receivable, we're going to say there's Anderson. There's Anderson's guitars. It went up by the 44895. I think that's right. I'm going to click on it and that should take us to the invoice. So there's the actual invoice. Scrolling down, that's the full amount, the 44895. Closing that back out. The other side should be going to sales. I'm going to close the hamburger while I remember over on the left. Scrolling back up, we're going to then go back to our trusty trial balance. I'm going to hold down Control and scroll up a little bit to see it a little bit larger to like 125 again. I like that 125 setting. 125. Then the other side is going to be on sales. So sales is down here. It would be a profit and loss report. We can see it all on the trial balance though, which is nice. So it's going to be the 780. There's the Anderson guitars, and it went up by only the 410. The 410, if we go back to the invoice, represents, and now I got to make it smaller to see the invoice. Oh, that represents just the amount we get to keep. The 410 up top, not including the sales tax. What about the sales tax? Well, that is what we owe to the state. So if I close that back up, that's going to be a liability. So that's back on the balance sheet in the liability section. So if I go back to our data up top, we can see that on the trusty trial balance. Here it is. It's going to the vendor that we actually owe, California Department of Tax and Fees and whatnot. And there's the 75. If we select that, then it gives the component parts to it, but it should be consisting of these 3 Anderson guitar items to make up the sales tax on that particular invoice. Scrolling back up, well, the other side that's going to happen, we also know inventory is going to go down. So inventory is an asset account. So inventory up top is here. It's going to go down. If I select that item, it's going to go down. Here it is for Anderson. And it went down by 328, but if I go to the invoice, I totally don't see 328 anywhere on the invoice. And that's because we don't want it on the invoice, but we want the invoice to drive it. How do we know what it is? Well, if we bit back to the tab over here and we go to our sales items, when we set up our items, I'm on the items tab, by the way, we set up the sales amount. And let's check it by the sales amount. What did we sell again? We sold a Steinberger. So that's this one. So there's the 328 right there. So that's the cost of it. So the system knows what it is, even though we didn't put it on the invoice. So that's good. All right. So if I close that back out and then I go back up top and say, go back to the summary, the other side of that goes into the income statement or profit and loss as the cost of goods sold. So the cost of goods sold, there it is. Let's take a look at it. If I look at that in the financial statements, well, what does that mean in terms of financial statements? I like working with the financial statements. So the trial balance, I'm not there yet. Well, let's go to the financial statement. Well, then the accounts receivable is going to go up top. That's going to be in the assets section. Accounts receivable is going up. And there's the Anderson going up here for the 448, the full amount. The other side, if I go back, is going to be on the profit and loss. So then I would typically think about it by going to the profit and loss report. Say the other side is going to be in the sales. If I click on the sales, it should refresh for us in Anderson, but it only went up by the 410, which is what we actually charged, not including the sales tax. I'm closing the hamburger. The difference is the sales tax. So if I go back up, that's not on the profit and loss because we don't get to keep it. It's going to be back on the balance sheet. So if I go back to the balance sheet, it's going to be in the liabilities because that's what the government made us collect from the customers so that we get paid to them and we don't get to keep it. So it's a liability on the balance sheet. It's for Anderson Guitars. So there's that. Closing back or going back up. We also had to sell inventory in order to generate that revenue. And the inventory was an asset. So it's up on the asset side of things. So the asset up top had to go down because we sold the inventory. So if we click on the inventory item, then the asset went down. There's Anderson Guitars again. It went down by that strange number that's not actually on the invoice, but what we looked up because we put it in there on the item. And then if I go back up top and say the other side of that is going to be on the profit and loss, and that's going to be in the cost of goods sold. So the cost of goods sold, the expense of us having to give up the guitar, which had that value being the 328 in order to generate the revenue is here. And the net between the cost of goods sold and the sales price is the effect or increase in net income, which ultimately affects the equity section of the balance sheet. So if I go back to the balance sheet then, just also realize that the accounts receivable is going to be supported by the detailed report by customer. I won't get into it now because we saw that last time. I don't want to go into it again, but there's that. And then we also know that the inventory will also be supported by the inventory reports that will tie out to this, which will tell us the actual inventory on hand and be tracking it using the flow assumption of the weighted average method.